This is Taking Stock on Bloomberg. I'm Pimm Fox. There were some positive signs on the economic front today as the number of Americans applying for jobless benefits decreased. Also, durable goods orders, they went up if you exclude automobiles and aircraft. Now, in spite of this, stock market, it finished the day down. So what's really going on? Here to tell us more, we have Michael Woolfolk. He is a managing director of Bank of New York Mellon. We're also joined by Dennis Hynes. He is the chief market strategist for RW Pressprich. He's a former futures trader at Bear Stearns and also a former managing director at Morgan Stanley. Gentlemen, welcome to Bloomberg. Good to have you with us. Michael Woolfolk, what do you make of the economic numbers? It seems as though anyone can pick and choose. If you're a bear, you take a look at the housing numbers. If you're a bull, you take a look at the 0.9% increase in durable goods if we throw out the autos and aircraft. So who's to believe the numbers?
Well, let's just make no mistake about it. I mean, these were very sloppy market conditions today, and certainly some of the correlations that we've come to expect, the positive correlation between the euro, for example, and stock market, it didn't hold. You saw the dollar losing ground with the Dow dropping triple digits in negative territory. So I think that one of the things that certainly is important this week is the FOMC's dovish statement.
The Fed Open Market Committee coming out and saying that the economy is weaker than they had previously expected, and as a result, what? No change in interest rates for a while.
And I think that as long as the Fed keeps kicking the can down the street with respect to postponing the eventual normalization of interest rates, this takes away from the strong dollar outlook in terms of its fundamental view of the street. So certainly the dollar can benefit near term from safe haven anti-euro type of sentiment. But I think longer term, you need more than that. You need to have growth differentials. You need to have interest rate differentials, and the dollar needs that right now.
Dennis Hynes, I don't know who's bruised more, that can that's being kicked down the road or maybe, you know, Ben Bernanke's foot. If we're going to have low interest rates, wouldn't that spell good news for stocks?
Quantitative easing has been used and used in excess. And what it's really done is it's starting to impact the confidence of the market in general. You know, what Michael talked about, good economic reports, it's always a function as to what the underlying temperament or sentiment of the market is. For example, in a bull market, bad economic news is ignored. In a bear market, good economic news is ignored. So I would suggest to you that after Monday, this past weekend, in front of G20, the concern by the Chinese was to save face. And so what they did was they threw out this little tidbit, telling you that they were going to make their currency flexible. The market rallied in a very big way over the weekend. And so we walked in, and I'm talking again about that ridiculous 1126 number on the S&P.
On the S&P 500. Everyone looked in and it was going very well, right? I mean, the early morning trading on Monday was fabulous. Then the market sold off.
Traded up to 1128, which is just modestly above. But that was the end, and that was the end of the good news as well. So without talking further about this, the fact of the matter is that the good news came out, the Chinese were helping, and the market sold off. So it's telling you the sentiment in the market's bearish.
And so if the market is bearish, that means any good news is going to be discounted.
For the most part.